All right, everybody. Welcome to Bits and Bips, where we explore how crypto and macro collide one basis point at a time. I'm your host, Austin Campbell, high scholar of Zero Knowledge Consulting, here with Chris Perkins, the golden hand of Chris. Have you got a name for the
Not yet,
spinoff
sir.
yet?
To be announced. Excited.
All right.
We
To be
actually
announced.
we,
The
we may or
golden
may
hand
not have one, but I
EVA.
could tell you, but I'd have to kill you. But it's coming.
Well, I've had people threaten to kill me for less. And then very excited to be joined by Cosmo Jiang from Pantera. It has been a very interesting week, to say the least. So I think we're going to have a lot to talk about today. Before we do, remember, nothing we say here is investment advice. Check unchainedcrypto.com/bits and bips for more disclosures. And before we begin, a quick word from one of our sponsors today.
If crypto taxes feel overwhelming, you are not alone. That's why Crypto Tax Girl, a team that's been helping crypto investors since 2017, is offering $100 off on one-on-one crypto tax help. To get $100 off your crypto tax services, go to cryptotaxgirl.com/unchained. Again, that's cryptotaxgirl.com/unchained.
All right. So today we're going to start with the market. There's a couple of small things happening. As people have probably noticed, spot gold fell nearly 10% on Friday, 5% more on Monday, trading down to 4,700 per ounce after peaking near 5,600 earlier this week. Silver collapsed about 30% on Friday, its worst single-day drop in percentage terms since March 1980, and remained down double digits into Monday. The realized 30-day volatility for gold rose above Bitcoin and to the highest level since the 2008 financial crisis. And since Bitcoin's launch, gold has only been more volatile on two prior occasions in total. Overall, precious metals had been rallying aggressively on safe haven demand, geopolitical risk, speculative inflow, heavy participation from traders in Asia, many sorts of narratives in the space. But notably, and Chris, I'm sure you'll have something to say about this, CME Group started raising margin requirements. Gold went from 6 to 8%, silver went from 11% to 15%. This forces deleveraging and accelerates liquidation. So gold remains up 66% year over year despite this fall down. Bitcoin is down about 21% over the same period. And in the current episode, gold has been acting as a higher beta asset. Today, JPM has been saying gold's pullback is probably done. So before we go any further into the markets, I'm going to pause there and see what people have to think. Chris, I'll start with you, thanks to the derivatives angle here. What are you making of what's going on?
I was hoping we we're going to start with our guest, but I'll give it a shot. We've been talking about this for a few weeks, and I think Ram was on last week, and he talked about how he was a seller of gold at that point.
Yes.
Clearly, your narrative took off. The retail hot bull of money got very excited. We're long-term investors like Cosmo, I'm sure is as well. And so we oftentimes have to ignore some of the short-term volatility. And we're seeing a lot of it because retail just jumps into something. And in the age of social media, just feeds on itself. And the narrative gets out of control. I feel like a lot of this started personally with some of the real politic decoupling that we're seeing, and that was put on display at the World Economic Forum. From there, you had a couple of central banks that are like, I need to decouple from the dollar. I'm going to sell treasuries and buy gold. And gold started going up. The narrative started getting out of control. And everyone's like, wait a second, Bitcoin lost its way. And why did those guys not buy Bitcoin, and why do they go right for gold? Well, because they're 70 and 80 years old, right? That's what they're going to do. Those are the guys who run governments and central banks, mostly guys. And so now that narrative started spinning, retail's like, oh, Bitcoin's not working. They pour in hop all the money. And then, of course, every time we see this, it's great till it's not. And then the market settles. I think fundamentally, there's something to precious metals still. I think that the narrative is real. I think there's a desire for real world assets, hard assets. Look what Tether's been doing and diversifying into gold. I think that's part of a longer term trend. I just think it got in front of itself a little bit. I don't think it's time to write Bitcoin's obituary either, to be honest with you. Again, that was an older demographic. It seems like it's it's pushing back to the 80K level. I still feel good about the setup. Want to get into some of the good things that we're seeing as well coming down the pike. I think with crypto, we need to talk about Warsh and how it all comes together. But I want to pause there. Oh, last thing on margin requirements. So this is how it works. People don't really understand this, but you have an exchange and you have a clearinghouse in traditional markets. Those are two different things. The exchange is where you trade. The clearinghouse is what manages the risk. And what people don't realize is that the clearinghouses are like the sun. They're the most powerful parts of market structure. They're fully centralized and they have incredible power. They have emergency powers. They can essentially wake up and say, hey, I want to do this, and everyone's going to do it. And effectively, they have all their members, by the back of the neck. Whatever they say, the rules apply and their members are bound. And so it's not uncommon for them to raise margin when assets, particularly commodity derivatives, get a little bit volatile. Why? Because they're trying to manage that systemic risk. The good news is that these markets that we're talking about today are regulated, despite some of that maybe too much discretion that these CCPs have. But there's an entire tranche of waterfalls and resources and regulation that prevents what we saw on 1010. On 1010, they had none of this stuff, and we're still going through it. I think we should really talk about. We're going to talk later, maybe about Star and Binance. But the good news is that it's again proving that though painful, and though sometimes you don't love trusting them, we haven't had a systemic risk issue after we centralized everything after the global financial crisis. So I'll pause there. Love to hear Cosmo's take.
Look, I mean, I think there are a lot of reasons, but as a market participant, I try to simplify things into Occam's razor. And the way I see it is, it's clear that there are real fundamental reasons why gold and silver were rallying, like Chris said, into the late last year. But it's very clear that retail got in a very big way. Retail, including a lot of crypto retail, that's moved their capital away from tokens to trad markets. And whenever retail gets involved in the last leg, things often end poorly, and that's what we saw happen. We're just seeing that things clearly got a little ran off too hard, and now they're pulling back really hard. And because a lot of the last buyers were retail and they're facing the losses, that's also bleeding into what I'm sure we're going to talk about next. Crypto prices being down because it's all the same buyers that bought that last leg and are now losing money again.
One thing I wanted to add, though, that I thought was fascinating coming out of this was hyperliquid. And you saw for the first time, right? You saw precious metals, derivatives on perps. Perps on precious metals start really seeing product market fit. Where, to your point, Cosmo, the line between crypto and like regular markets is starting to blend, even in the retail space. So watching that price action on hyperliquid to me was like a fascinating, probably very positive step where you're seeing DeFi and real world assets coming together in the derivative space. That, albeit it's unregulated, but seeing retail focus on commodities exposure in hyperliquid, fascinating and a positive step forward, I think, for our markets. What's your take, Cosmo?
Yeah, I have a few thoughts there. I think on the point about on-chain capital markets or internet capital markets taking over, we are absolutely seeing that play out. Right. The fact that hyperliquid volumes on silver and gold are exploding right now, just as retail attention is coming onto them, really speaks to the idea that the reason why hyperliquid is amazing is because it is a permissionless system where anyone can open a market. So someone said one day, hey, I think gold is going to get traded. Let me make sure that market's available on there. Everyone found that market and started trading that on hyperliquid without some centralized entity stepping in to make sure that's the case. And now, on weekends, famously, traditional markets don't trade. Saturday and Sundays don't trade, but they do trade on open permissionless blockchains like hyperliquid. And there's a really great chart that came out over the weekend. But basically, you saw the price of silver over the weekend. It seems like hyperliquid actually, there is reasonable depth, which you wouldn't see otherwise in a normal macro market, there, so that people could trade silver in and out. And by the way, by the time futures markets opened, or when CME silver opened at 6 p.m. Eastern, Hyperliquid's price actually was only 50 cents off, or like, within percentage points off of that eventual opening price, which is, within the margin of error for S&P futures opening. So clearly the price discovery is actually happening on internet capital markets now, which is truly, truly incredible and exciting. I've even had funds, there are lots of funds, primarily crypto related, but increasingly that we're going to see a lot of them choose to trade the silver and gold on Hyperliquid instead of on CME, because they can risk manage on the weekends now, and because they can react on the weekends what they can in traditional markets. That's really the crossing the chasm that we're going to see soon.
It's simply a better product, right? Just like we talk about it all the time, equity tokenization. Tokenized equities are better products. You can trade them on the weekend, and guess what? Markets move on the weekend. Totally agree. So that's HIP3, right? But we're hearing now that HIP4 is coming out, which is also pretty interesting, because now we're gonna start seeing prediction markets. So not only are you seeing like real world assets coming together, but this everything app concept seems to be consolidating too. So like really, really interesting trends that we're witnessing.
I would hop in on that one, Chris, to emphasize, and Cosmo, you just said this, like money is going to go where the liquidity is, right? Traders want to be able to trade. People want access to prices and information and liquidity 24/7, right? And the, call it market convention of stocks only being open part of the time, right, has historically permeated into these markets. But actually, gold's a great example of a market that trades 24/7 in spot, right? Like nobody is stopping people from exchanging gold on the weekend, right? When we're talking about physical delivery, we just shut down the futures markets. And so sort of making these into round the clock markets, I also have this view that as these take off on places like Hyperliquid, you're going to start having a pull effect from traditional finance. Cosmo, exactly as you said, is funds are going to move away from the CME, and people are going to start using Hyperliquid because you can manage your exposure 24/7 without this bizarro jump risk. And once people see that for like gold, next thing, like Chris, here's a shout back to 2008 for you. How about CDS, right?
Oh,
like
God.
moving these markets to 24/7, I think creates a informational change people are not pricing in.
I think there's something more to it than just 24/7 too. And what we're seeing now is a world where trust is being lost in many cases, and people want to, and people are very concerned. So like we talked about this narrative of, oh, I'm going to decouple from the dollar. I can't depend on the US anymore. I'm going to buy gold. Gold's really hard to buy, like storage costs. We talked about the discombobulator. If somebody wants your gold, they can come in and apparently take it. And so that puts you back into the derivatives markets, which tend to have more liquidity. The problem is now if you go to the centralized derivatives markets, particularly onshore, CME, ICE, whatever, you're reintroducing that trust because they're absolutely governed and regulated. And there's a benefit to that. There's an absolute benefit to that. You don't have the 1010s of the world, but there's a drawback too, because if you're, a guy who's trying to decouple from the United States, that's not how you do it. So I do think that could be a really interesting tailwind for more of the DeFi, the perp dexes of the world, if you have that liquidity. I just don't know if it's going to take a while for them to get institutional size is my concern. But hey, you got to start somewhere.
Counterpoint, I think over the weekend, Hyperliquid did what, percentage points of CME volume already in silver? Like that's a pretty decent product launch out of nowhere.
Yeah.
So, all right, then I want to bring this back a little bit to where we had started with some of the gold narrative and like the vol shock that is propagating through there. Exactly. It's too bad Ram's not here today because he had sort of called, hey, I'd be a seller of gold right now. This is looking pretty toppy. We're seeing a lot of like, call it retail type stories of people say walking into stores in size and amounts that has not been seen in decades that indicate tops. But an interesting part of that is that we're sort of now with these markets being able to see the vol shock and like retail interest moving through different asset sectors. So I want to come back to something that, Chris, we were saying about metals and markets and sort of like the omni ledger concept. Do you think there's any validity to the critique that letting these trade 24/7 and putting them all together is just going to cause like vol shocks propagating through all assets?
It could be a near-term issue. Like, by the way, people around the world trade. We just get focused on U.S. market hours sometimes because that's how liquidity accumulates. One of the biggest concerns around auto liquidating markets, and I heard this when I was in front of the CFTC, back in 21, was that, low liquidity, the farmer's going to wake up and he's going to get liquidated, and that doesn't work. It doesn't work. So I think you need to have a gradual rollout, but let's also not forget what happened in the last few days with Claudebot or Moltbook or whatever else you want to call it. People are going to be trading less and less as we move into the future. The bots are going to trade around the clock. They don't get tired. They don't care what time it is. And so they're going to want to trade 24/7 markets. And so I think this interim challenge of hey, low liquidity on a Saturday night is fleeting, because liquidity is going to be driven by the market, and I think less so by human biology. My 2 cents. But it's something that we have to be careful of in the meantime. That's why we're not going to race and start auto liquidating, farmers, which, I just don't. I think there's room for both.
All right. So speaking of regulators, auto liquidations, and policy, we probably should get to the Warsh nomination as well. So Donald Trump nominated his successor to succeed Jerome Powell as Fed chair, which is coming up in May. Some would say this is triggering a reassessment of Fed independence in the path of rate cuts. Warsh has widely been perceived as more hawkish, expecting increased real rates, and it may have hit gold to some extent. Some have said the hedge here is to diversify internationally, such as Macquarie global rates and currency strategist Thierry Wisman, stay with U.S. growth, but you hedge out your dollar exposure. Neil Dutta was pretty blunt, saying, I don't like the pick. The Fed is bigger than any one person at the margin. Warsh represents a bit of uncertainty, but the dollar index strengthened roughly 0.8% since Thursday. So I'll just go to the group here. What do you guys think of this nomination?
Is that Cosmo?
Cosmo is transformed into a robot.
I think I said bot and you transformed. I think you have an audio problem, buddy.
Got him.
You might want to log back in.
All right. So while that happens, Chris, Warsh, what are we doing?
I think the crypto markets in particular have been a little bit harsh on the Warsh nomination. That's my 2 cents. If you look back, this is not the first time he's been in the seat, right? I think he was 35 years old, one of the youngest. So he has experience. He's coming in here knowing what he's doing. The thing that astounds me about his nomination and why things make sense to me is how often, Austin, have we seen somebody get nominated to a position of incredible power and say, you know what, I want to make my agency smaller. It's very, very rare. Usually you see them say, no, I want to be bigger. I got this big ego. I want power and control. And it's not dissimilar to what we're seeing over at the SEC, where Paul Atkins is saying, well, wait a second. You know what, guys, these commodities, they're not securities. I don't need them. Let's let them sit where they belong, right? So in both cases, and so you have this Selig and Atkins thing going on where they're like, hey, listen, let's put the egos aside and let's just get it right and let's work together. You have the same thing going on with Warsh and Besson, right? Where you're saying, okay, listen, we think a smaller Fed, a more focused Fed makes sense. The Fed got over its skis. It's outside its remit. I'm going to bring it back down. Contrary to, like I said, I'm not looking to expand power. I'm looking to shrink and focus and get back to my mission, smaller government deregulation. And I think there's going to be a new form of Treasury and Fed accord. What does this mean? This means in certain cases, the balance of power is going to shift to the Treasury. What does that mean? That means the Fed is going to stay independent, just like it always has been. Its mission will be more focused. They're probably going to get out of the QE, QT game. And then Besant, who's controlling debt issuance, who's really in love with stablecoins and sees it as an important future for the power of the US dollar, is going to export stablecoins throughout the world. And he's going to have more control over the balance sheet. So it's a shift in power. Now, what does that mean? You're introducing a degree of politics in certain cases. But again, is that a bad thing? Independence is important for certain things. Maybe it's not important for others, because as you elect governments, they're going to make decisions and their voters are going to hold them to account. So it's going to be interesting to see where this balance of power plays out. But what makes me happy is it doesn't seem to be driven by egos. It seems to be driven by people that are ideologically aligned. Used to work with the same guy, and I think it's. I honestly believe that the crypto markets have maybe gotten this off. Cosmo, are you back, man?
What do you think?
How I sound? Am I Claude Bot
Good,
still?
man. Yeah. No, you're good.
You are no longer an agent.
I wish I was as effective as a Claude Bot. I'll tell you that. Yeah.
So, all right. So I'll go next to give you time to gather your thoughts on the Warsh thing and say this. I think there's sort of three competing elements here, and that's why the reaction has been jumbled. One that's interesting to me is this is not cut across traditional ideological lines with this nomination. Like, you did not see the reaction of Republicans uniformly love it, Democratic people uniformly hate it. Like, this was more like, oh no, right, and confusion across the group. I'll steelman the arguments against by saying I think people have looked at his views from 2008, where he was late on the crisis and then wanted to pull back liquidity early, and has consistently been raising concerns about shrinking the size of the Fed balance sheet, as saying this guy's legitimately a hawk. On the other hand, Chris, to your point on the ideological alignment, this might just be a recognition of reality that in a world of a debt to GDP of over 100%, we have sort of fiscal dominance, and that Treasury may be playing a more important role in some ways than the Fed right now as relates to how things work, and that things should probably recognize that. Similarly, the whole I want to shrink the Fed's balance sheet, the other side of the equation is, of course, interest rates. So if you shrink the balance sheet but also cut rates, that's probably net neutral, right, as we look about what's happening if you balance those forces. So I think looking only at one variable here is what's producing this sort of dispersion as we try to evaluate this pick. I think the strongest counter argument against has been he seems to have flipped his viewpoint on things back and forth based on political expediency, but maybe the strongest argument for is with Treasury and like fiscal policy dominating things, you might not want an ideologically rigid Fed chairman. So I think people are looking at the same set of facts and seeing two different potential outcomes depending on their model of the world.
Yeah, I mean, I was going to say that just, I think you guys really covered it pretty extensively. I would just say he is I think the sober pick that at the very least, calms the market. I think there's certainly concerns about how co-opted by President Trump he has become, but I think for the large part, this financial establishment really supports him because he's been around the block. He knows how these things work, and some of his views are pretty out there, but at least people know that they're well-intentioned, well thought out, and therefore, something that you can plan against.
So here's my hot take, and I could be totally, totally wrong, but I tweeted this out earlier today, and I'm actually shifting, Austin, my take. I think Clarity Act gets done.
Okay.
And here's why. The Warsh check, the Warsh appointment has obviously set crypto markets back, like it or not. Again, I don't think it's as bad as people think, but crypto's hurting. And some of it was probably, well, I don't want to say it's our own doing, because 1010 to me was an effect of pushing everything overseas in the last administration. Yeah. But a lot of crypto's been hurting. And I think we're that's the truth of the matter. And so now with this additional layer of pain in certain cases, I think the president wants a win. He really wants the crypto. He really wants a crypto win. And to me, that's the market structure bill. And so today they've assembled a bunch of folks from the crypto space and the banks to bang out the final policy agendas items. Somebody yelled at me and said, "No, they're not going to solve them. They're just going to start talking again." Whatever. I think the policy items are solvable. I've always said this. We can figure out, let them pay a little bit of interest to retail. Okay, banks, we're going to lower your capital levels. Everyone's happy, whatever. But the big question is the political side. And as we march towards midterms, you got Fair Shake with their $100-something million war chest, right? And you got the administration with a bunch of chips, right? They can spend those chips in a number of different places. I think they're going to start spending them to get the crypto bill, to get the market structure bill, to get clarity done, because I think it's very important for them. Trump has said from day one, I want to make the U.S. the crypto capital of the planet. It doesn't feel good being on that planet right now, but I think I think now is the time that they're going to spend the chips to do it. So really freaking hard to do, right, Austin? But I feel like the stars are aligning, and that could be the next leg up. My 2 cents. Come at me.
All right, I'll take the other side of that one, which is I don't think it's going to happen. And I think there are 2 problems with what's going on right now, one of which I think is solvable. So let's start there. So on the yield thing, I think most of what's going on here, if I'm being honest, is insufficient understanding by the majority of banks on what is happening. And I think it is call it education problem. One thing that you see a lot of when you talk about stable coins is banks, especially smaller banks, community banks, having their lobby run around saying this is going to destroy us, right? Like we're going to lose all of our deposits, et cetera, et cetera. But I'm going to remind people of like some factual statements here that there is no way to contest. Like everything I'm saying here is a truth. One, community banks have been systematically losing deposits since 2009 and having it flow into, call it, the top 20 banks. They've gone from about 55% of total deposits to like 70% of total deposits over that time frame. That is over $1 trillion of deposits. There are mechanically not enough stable coins to be responsible for that, and most of it occurred before 2023, before stable coins got big. What's killing them is technology, right? Like the number 1 growing bank in Michigan is SoFi. 2, when you create a stable coin, banking deposits don't change, right? Like Cosmo, if you at Pantera buy a stable coin from Circle, you have a bank deposit. Circle gets the bank deposit, you get the stable coin. There is no net change on deposits. And in fact, some of the banks that have gathered deposits best have banked the stable coins. And it's because of that one-to-one swap relationship, right? Like go look at historically Silvergate and Signature, now like Customers, Lead, Dart Bank, people of that sort are actually gaining significant amounts of deposits, understanding this problem. 3, most of the buyers in the first place came from outside of the United States. Right. So what we're doing is reshoring funding from FX markets with increased demand for dollar deposits. And finally, the stable coins hold primarily bank deposits and overnight reverse repo, which is more funding for banks, right? Which is why it's hilarious for me to see like JP Morgan fighting about this and like Jamie Dimon dropping the F-bomb on Brian Armstrong. Like, Jamie, I used to work for your bank. If anybody shows you this, your bank benefits more than anybody else in the world from stablecoins because of your rates, franchise, and repo trading desk. Don't fuck this up. I still own a lot of your stock. So punchline, right? Like the banks are actually on the wrong side of the issue. I think you can get them on sides because it's foreign banks that should be upset and U.S. banks that should want U.S. dollar stablecoins. This is good for us. So I've said all of that. I think that problem's solvable. Hopefully the meeting today goes well. Chris, I know you and I have talked about that. Here's the thing I don't see a solution to. How do you get any Democratic votes for this if their one sticking point is the ethics? Like
that's a tough one.
To the bill?
That's the tough one. And that's why chips are going to come on the table. Fair Shake's going to do what Fair Shake does best.
But if Fair Shake, okay, so here's a question for Fair Shake. If you have all of the Senate Democrats who voted for Genius saying we are a yes on clarity and will vote for it so long as you attach the ethics amendment, are you going to go after them in the general election or the primaries on that basis?
Well, I think we all know the right thing to do, and that's to address ethics holistically. And
yes.
So the answer is, you don't go after them for that. You push them to put it out as part of the deal. Holistically across every single asset class. That's the, whatever. Cosmo, do you have a view?
I think the market structure legislation, I'm very, I think I'm very hopeful that it passes through. I think it's going to be really important. But I also don't harbor any doubt that this struggle, the fact is this blockchain is just one of many things that the government needs to focus on, right? And the fact that we got to be front this year is pretty incredible. At some point, it's and the fact that we got stablecoin legislation in 6 months is like truly, truly incredible, given how how dysfunctional our government can be. At some point, they need to move on to other things. Like blockchain is one part of the economy, and they've got thousands of other things to do. And unfortunately, the recent as we got so close to the finish line, the recent friction that erupted, I think has put us back on the back burner again and deprioritized it for the administration. They've got too many other fires to burn before the midterms. That said, and I think a big signal of that was when the SEC and CFTC chairs came out last week to say that, hey, like, if legislation doesn't happen, we're going to start with rulemaking. And I think that's a very tacit acknowledgement that legislation is kind of far, so maybe the regulators are going to step ahead and take charge.
Yeah.
So net, we might still get the benefits of it, but
to be honest,
it doesn't seem like the legislation is coming.
I think we're going to be fine either way, right? I've always said that, because even if there's like a Gary Gensler gets reappointed in 3 years from now, it's awfully hard to unwind 3 years of precedent. So like, the regulators are going to do their job. They're going to do God's work. It's going to be awesome. But I do think if you do have that enshrined law, it's gonna push the throttle down. It's going to accelerate this cycle, and this is the institutional adoption cycle. I think they're going to go faster if there's a law in place, because then there's no turning back. I think they may hedge a little bit or move a little bit slower without that law, but net substance perspective, we're going to be in a great place.
I will counter that and say I actually am not certain the best path forward isn't Clarity not passing right now, Chris, because
that's a lot of double negatives, man.
All right. I'll say it. It might be good if Clarity doesn't happen. And the reason is, if you give a competent SEC and CFTC time to write rules, and you see those rules happen in the wild, and you see things occurring, some of the things that are currently grinding the gears of Congress, like say the AML KYC thing, might just go away when they see things operating in practice. And like the SEC is actually a great example here. I was very critical of Gensler's leadership at the SEC, partially because they kind of let the unelected non-lawyers in policy run the shop. Some of the best staffers who kind of understood these things are not new, it's just stuff on a different ledger. And some of the enforcement people who wanted to go after the actual scammers were all sidelined right under that regime. Now those people are being brought to the forefront and allowed to do their work. And as you said, if they go through rulemaking, right, it's very hard to undo that, because now you've got to like go through rulemaking again just to unmake the rules you made, and then go through rulemaking yet again to make new rules. It also eliminates a lot of the arguments the SEC was making under Gensler of like, oh, well, we haven't put forward rules. They have to, no, you had rules and they can rely on those. You kind of get no backseas on that. So I am not 100% certain it ends up being a bad thing. And because here's the counterpoint that I want to put to you, and I want to see whether you agree or disagree. Given that Genius happened and is law and can't essentially be undone, I feel like the regulators now have to grapple with blockchain. Like, the ability to just ignore it is gone, because whoever you are, your regulated entities will be touching stablecoins.
Spoken like a true stablecoin maxi, right? We got a good law on the stablecoins. Let's not ruin a good thing. Let's not roll it back with market structure. I hear you. But you're right. There is some credit there. Now, let's remember, there used to be this thing called the Chevron doctrine that allowed regulators a lot more freedom of maneuver. Some of our former SEC chairs went too far, and now it's, the Supreme Court rolled it back. So I don't disagree. Like, I do think we're going to be in a good spot either way. I just think that if you get the law down, it just presses you press the accelerator on this institutional adoption wave that we're already seeing. Cool. Cosmo, you back with us, buddy?
He is back with us. But
awesome.
I think so. Do you see me?
Yeah.
We do see you. All right. We're going to stop seeing all three of us momentarily, though, because we need to go for one more ad from our sponsors before our next topic.
If you're looking for help with crypto taxes, Crypto Tax Girl is offering $100 off for Unchained listeners. They provide personalized crypto tax reports and returns, and spots before April 15th are limited. Go to cryptotaxgirl.com/unchained to save $100. Once again, the link is cryptotaxgirl.com/unchained.
All right. Welcome back, everybody. Chris, I'm just going to leap into the deep end here because you had mentioned you wanted to talk about the market side of thing as well in crypto, and you've mentioned token prices. Bitcoin,
Why would you do that?
Yep, Bitcoin 9-month low, ETH 2,200 before stabilizing, altcoins broadly lower. 4 months in the red for Bitcoin right now. And in particular, one of the things we're seeing a lot of here is people talking about stress in the DAT complex. What is going on in the crypto market? What is going on with DATs?
I think we should start with our guest, don't you think?
All right, Cosmo, let's do it.
Yeah, I mean, look, I think a lot of people like to try to find a witch to blame when things are going down, and I think there's a lot of concern, I think over concern about the DATs and what part they play in it, which is very little to none, no part in this. Um, I, I I think the reality is that DATs are highly reflexive vehicles. They perform well. They have to realize they are Bitcoin in a box or Solana in a box, right? And so if Solana or Bitcoin is down, DATs are going to trade down. If Solana and Bitcoin are up, they're more likely to trade up. And I think because a lot of their value comes from the demand for and the belief that future prices will be higher in the future. You need to believe, if people don't believe that prices are going to be higher in the future, DATs will trade at a discount to NAV. So all that's to say, though, like it's not like DATs are selling much, if any, tokens at all. So DATs are obviously not the problem. Like mechanically, could not possibly be the problem. I think there's a lot of concern about MicroStrategy. I think the concern about MicroStrategy comes from people who have never seen a balance sheet ever before in their life. If you look at the balance sheet of MicroStrategy, obviously their debt is tiny. It's like 8 billion of debt termed out from 2027 through 2029. So Bitcoin would have to hit 11K and stay there for 3 years straight for MicroStrategy to go bust. Anything could happen, but that seems very unlikely. And so it just feels like there's a lot of other reasons why the markets could be down, but it's definitely not because of DATs.
All right, so Chris, go ahead.
Yeah, I mean, DATs are super young too. MicroStrategies, I don't know, Cosmo, when it was started, maybe a couple of years ago, but the preponderance
21.
of the 21. The preponderance of the DATs are less than a year old. Is that right? DATs?
Yeah.
I was going to say, I think the majority of them are probably rolling around 1 or less than 1 year.
Yeah.
It's really MicroStrategy that's the long-running one.
That's
it
right.
had to predate the ETFs.
Like these are brand new innovations. If you look at it through and yes, they're public companies, but if you look at it as a new innovation, I mean, how volatile are new companies when they're formed? Like this is something new the market hasn't really quite figured out yet. What gets me excited about it structurally, and I've been a huge bull of DATs on the show, is that it's that perfect convergence play between crypto and capital markets, where you can have access to those robust traditional markets. It's an entry point and structured correctly. And Cosmo's the guy who can walk you through. These are very it's crypto in a box, operationally easy. In certain cases, you can get even hyper exposure to that crypto. But the other thing I'm seeing now, which is fascinating, is we're seeing the DATs go in different directions. I don't know if you saw it last week. Was it last week, Austin? ETHZilla went out and bought an airplane engine, was getting into the airplane engine space, right? And using blockchain technology, the Ethereum blockchain, to make the structuring more efficient. So I think in time, many companies will be, quote, DATs, if that means they're holding crypto on their balance sheet. I don't know if we've got a good doctrinal definition of DATs, but these worlds are colliding. Companies are going to be using blockchains more and more. They're going to need to have crypto on their balance sheets to use those blockchains. There's going to be M&A, as we've talked about. So the problem with DATs is it's so early. And we're also, we've been living in this world of the retail hot ball of money. When it comes to price action, they went off into gold and they went off into other things. It was hot at the time. Who knows what's going to be next? But against that backdrop, those institutions continue to step forward. And I think in the longer term, you're going to see probably less volatility. Last thing I'll say is volatility works in both directions. It's been down recently. We've seen periods where it's been up. So hang on, stay long-term in your focus, zoom out a little bit. And, I personally, for people like us, we're committed to the space, I remain very long-term convicted on the asset class, on the innovation that's happening, on things like that. What about you?
So I think there's an interesting point here where we start to see divergence between the tokens and the DATs. And what I mean by that is if you're currently Michael Saylor or you're thinking about like strategy and you're trying to figure out what to do, you almost have no good options right now, because if Bitcoin falls enough and it's below the strike you've been buying at, and you've got outstanding debt that you have to service, you want to hoard cash so that you can service your debt so that you don't become a forced seller, but you don't have more cash than to buy more Bitcoin. You don't want to go out and issue equity at this point and dilute everybody, and you don't want to issue more debt. You're kind of stuck just sitting there hoping that prices go back up, and if they don't, you have a little bit of a problem. Flip side of the coin, Chris, to what you were saying about long-term conviction in the space. These kinds of things are only a problem if you have significant fees you've got to pay or you've got debt outstanding. If you're just a person holding Bitcoin on your personal balance sheet and you don't need the cash, you can do the Warren Buffett thing of just waiting indefinitely with an infinite time frame. And in that case, you are the one with the fortress balance sheet, right? And so part of why I'm looking at the reflexivity of DATs in particular is if they start trading at a discount to the assets over the long term, there becomes an incentive even for people who like the assets to take the DAT apart, like crack that thing open and take the like chewy center out of it, right? Because I love to buy dollars for 80 cents. I don't know about anybody else. So if you like the assets at a DAT that's trading at a discount, take the DAT, kill the DAT, just take the assets and put them on your balance sheet. And so to me, this is a corporate governance question about the structure that people have layered on top of the assets. It is not a question about the assets themselves inside of these. I think that's a separate thing. Like I might be short a lot of Bitcoin DATs and yet very long Bitcoin. Let's put it that way.
Yeah. So Cosmo, we've been talking about how to weather the MNAV less than one storm. And I think there are haves and have-nots in my mind. They're incredible management teams who plan for this, have a plan, understand how to navigate these waters, and then there's those who don't. But Cosmo, would love your thoughts on how the best DATs navigate these MNAV less than one environments where the value of the asset is not accounted for in the valuation of the stock.
We'll see if we've still got him.
Oh,
all right.
We lost Cosmo.
What we're finding out is that Cosmo's audio has been sabotaged by short sellers who want DATs to fail, so that he can't give us that answer, right, Chris? No.
Yeah, that's right.
All right. Look, so man, let me steel man this one as a former distressed person.
Oh, here we go.
There is an answer here. So number one for a lot of the DATs, and I'm going to say this and it's going to sound funny to a lot of people, if there's no imminent stress, do nothing is sometimes a totally adequate solution to this problem, right? Like in finance, just wait is not something that most people promulgate as a strategy. But if you really have long-term conviction in an asset, sometimes your answer is just wait. Number two, Chris, that you, I think, were alluding to earlier with people doing things like buying jet engines, it is find creative ways to start bringing both the retail attention back, but also unlocking value into the ecosystem that your token is part of. Because if you're, let's say, a Solana DAT, like let's take an example of something that exists that we haven't named yet, and you start through the efforts of your employees, brokering deals in the Solana space, bringing people together as partners, educating people on the asset so that you can get TradFi using it. That will increase the value of the assets that are in your treasury without you spending like money on the thing. And one of the things people underestimate is some of these DATs have a very big megaphone, right? Oh, yeah. Like if Kyle Samani goes out there and really starts pounding the pavement and trying to bring people in, that moves the needle. And so I think there are levers to pull that are non-financial and just patience if you're not under siege that can help here. What do you think?
I'll push back a little bit on that particular example. Some of these folks have a lot of visibility in the crypto space, but that's not the play here. The play here is for that visibility in mainstream, and that's why people have been very critical about Tom Lee. Where ETH is now versus where it was, but it's a volatile asset. It goes down, it comes back up. But the Tom Lee play with Mr. Beast, like, talk about having a big megaphone. That's as big as it gets. But I think one thing you're talking about, Austin, is operating companies, right? Yes. What you're seeing is DATs. Many DATs right now are looking for operating companies, are looking for operating revenue. And then, you have other trad companies that are looking for crypto and to integrate blockchain. So, like, the world's converging, but I think that's right. Should we go back to
Cosmo back?
We got him back.
Now I'm just going to hit Cosmo with the question cold and see what he says. Yeah. Cosmo, if you were in charge of a DAT that is currently trading below MNAV, what do you do? The answer is we still don't have audio. All right, we'll see if we can get this fixed.
All right, we'll keep going. We'll keep trying that. No worries.
All right, Chris, you mentioned something earlier that I also want to get to today as we're working on this one. The framing around a lot of these things, if you're seeing like Bloomberg intelligence strategist Mike McClone, if you're seeing some of the ETF outflows and people commenting on that, reminding people that the current ETF buyer is underwater for the average buyer, do you think we see a further leg down in Bitcoin as a result of these TradFi forces, or do you think we're at the point where people are just like buying?
So it's hard to call a bottom. And I think we have Cosmo back again, but it's always difficult to call the exact moment of when a bottom occurs. It does feel to me like the market is bottoming. And the thing that we've seen is narrative does drive inflows here. Like, you want new money to come into the space. You want to see the token go up. So what's the impetus for that token to go up? Like, that's what we're looking for. Remember when Solana was on its was not doing great. They issued Bonk, and that was the spark. That was the catalyst. So, like, I feel like we've got some really amazing fundamentals out there right now that are working. We have a very pro crypto regulatory environment. We have laws that are moving forward. Whether or not they get passed or not doesn't matter, because we're having precedent being set, right? Macro, I think probably people overshot the worst thing, as I discussed. And you also have like this realpolitik decoupling where it's like, I don't trust anyone, trustless, permissionless. If only there was a technology, right? So I feel like volatility goes in both directions. We're one spark away, and then like that, when does it bottom? Well, it's when there's not as many sellers as there are buyers, right? Hard to tell exactly when, but it feels like this thing is happening.
All right, Cosmo, do we have you back?
Possibly. Can you hear me?
Yes. All right, let's do it. So I want to come back to the question that if you were in charge of a DAT that is underwater on MNAV, what are you doing? What is your strategy right here?
Well, I want to be careful because I am a director of our Solana company, HSDT. So it is a DAT.
Generic, let's say a Bitcoin or Ethereum DAT to keep you out of trouble.
I think you have a few options if you're a DAT trading below NAV, right? I think your number one goal should be to maximize shareholder value over the long term. Really maximizing shareholder value. If you're trading below NAV, it suggests that people think you are going to destroy more value over time than create value. And I think, the simplest thing is, first, you got to look yourself in the mirror and ask yourself, do you have a reason to exist? And I think, when we first, we were the ones who sort of unintentionally started this whole boom in DATs last year when we started funding the first few. And I'd say that when I first started, I thought, maybe one or two, maybe three across each of the large cap assets. Clearly, we have, dozens. And so that's obviously too many. And so you have to ask yourself, like, am I going to create value for shareholders or not? If not, maybe it makes sense to unwind and return capital, right? That might be the best shareholder value maximizing thing to do. Yeah, there is some friction cost to that. So no one's going to get 100 cents on the dollar, but 95 cents, something like that.
If the other option is if you do believe you're one of the few that can really succeed long term and build real value, then there are many ways to build value. When you're the beauty about DATs is whether you're trading above or below NAV, you can accrete shareholder value, right? If you're trading above that NAV, you should be issuing stock. That's accretive to shareholders. If you're below NAV, you can buy back stock, and that's accretive to shareholders. And so so I think any DAT that is trading below NAV should be thinking about that as a potential tool. And if they feel like it's time to wave the red flag, like consolidation is always helpful. Maybe returning capital isn't the right thing to do, but if you consolidate with someone together, 0.8 plus 0.8 might equal 1.2. And so there the potential for consolidation is there. But regardless of what management teams think or do or feel, and I've been in the public markets, all my career, long enough to know that oftentimes management teams don't do what's best for shareholders, but shareholders are going to look out for what's best for shareholders. And so we're already starting to, and we will continue to see more and more shareholder activism as more of these DATs, wallow below 1x NAV.
Yeah, and to me, I think you hit on something that's very different about traditional markets than crypto sides probably need to understand, which is the shareholder dynamics, right? It's like, who is really driving the ship here and what does this ship exist for? Chris and I were talking about, I think you implicitly endorse this, given there's probably too many DATs and some of them need to go away. If you've got assets inside of a DAT that are trading significantly at a premium to the MNAV of the DAT and continue that way for a long time and you're not growing and having no impact, you crack that thing open and let the value out.
Mm-hmm.
And everybody is better off. So, that was the genesis of my comment. I might like some of the tokens more than I like some of the DATs, if that makes sense.
Right.
but to your point,
well, I actually think it's opposite.
Consolidation is possible for that too, right? Like,
if you trade below NAV, I actually kind of like these discounted DATs more than I like the token. Because yeah.
Okay, so in theory, I'll ask this as a hypothetical for the group. Are we going to see DAT M&A? Because if you're a DAT trading stronger, do you look at DATs that are trading below MNAV and just acquire them so that you're paying less to put assets on your balance sheet?
I think you would be, as you would expect, every banker has pitched every combination under the sun. And so this is certainly an obvious choice that people are talking about. Now, it takes two to tango. And going back to my point of not all management teams, like this is not unique to crypto. In equities too, not all management teams watch out for their maximizing shareholder value. And so it may be the right thing to do. They may not do that. But for sure, you should anticipate that everyone's kind of eyeing each other. There's already been, one DAT M&A that's happened. ASST or Strive Asset Management bought Semler Scientific. And so I think, that deal came together very quickly, and sort of every deal has very unique circumstances. But I would expect that there's more M&A, especially as shareholders get more active.
Agreed. Cosmo, I want to ask a question of you. One of the trades that I think could be really interesting this cycle is a take on the basis trade, where you find a token. And one of the problems with this is like the futures markets are not yet that mature. But you find a token that's in contango, right, where the future price is higher than the spot price. And you find that DAT that's trading at an MNAV less than 1. So you get the extra juice there. I think that would be really cool. Do you think that's going to be a trade that comes along? And we've been waiting for the futures markets to get a little bit more.
Yeah, mature. Possibly. What do you think? I mean, if anything, it's even better than it's because both of those consist in your TradFi brokerage. It's even more capital efficient, right?
Exactly.
Than doing CME versus DEXs. So yeah, I mean, we could definitely see that happen.
Good.
Let's get it done. Not a lot of them trade with too much volume yet, but it makes a lot of sense to me.
So that was one of the reasons that what led to the run up on the last Bitcoin surge is like, as big institutions came into the space, they wanted to capture that basis. Like we said, like Bitcoin doesn't have a regulatory problem. It hasn't had one for years. It had a volatility problem. And you're going to see that with the rest of alts. But you mitigate that volatility problem if you can trade basis. So you buy the spot, you sell the future. And when that happens, the spot goes up because you have more buyers and sellers in the spot leg. And so maybe that's, as futures come on board online a little bit more robustly, if you get that contango, which is, again, the future price is higher than the spot price, could be really fun to play.
Yeah. Well, I look, at the very least, I think there's an actively managed strategy to be had around buying token, selling debt, or sorry, buying discounted debt, selling token, hedging out with token, or trading around these debts. Like if there's a debt trading at 0.5, if you can get it back to 0.7, that's a 40% gain, right? And so like there's a real strategy around, there's a real hedge fund strategy around buying discounted debts, trading around them, selling them as they get closer to NAV, or if you think they're going to trade above NAV. And I think there's a lot of
as you underwrite that. As you underwrite that, what do you do? Focus on the team, management team?
Yeah, I think it's all about the team and like whether you think there's a real catalyst for the discount to narrow, right? The reality is if you find a management team that is not interested in doing the right thing, they will trade at a large discount to NAV. And the market is actually pretty efficient at sniffing that out. If you look at some of these debts, the guys trading at 0.5 or 0.6, there's a reason they are. And it's because probably the shareholders have talked to the management teams and realized these guys aren't riding with us. But like, the guys that are trading at 0.7, like it's closer to realistic and maybe they can trade up to 0.9. And so there's a 0.7 to 0.9 even is a massive, massive upswing.
Yeah. I would also say, I think some of that's going to come down over the long run to control, right? Like Cosmo, back to everything you were saying, some of these are tougher nuts to crack than others if you want to change that, because the obvious answer, if you're trading at 0.5 and the management's not aligned as the shareholders, well, change the management.
Right.
And the question is then, are we talking about, okay, I can take a controlling stake and easily shuffle these people out in traditional corporate way, or are we talking like Paul Singer level, I'm going to have to start physically stealing their stuff to get them to like change over here? And I think that probably accounts for, over time, a significant amount of those discounts as well. All right, final one before we roll today. Since we had brought it up a little bit earlier, we talked a little bit about 1010. So there are some claims flying around about that. Star, CEO of OKX, has been saying that the October 10th crash was triggered by Binance's treatment of Athena's USDE. He pointed to the high APY campaign and USDE as collateral, enabling essentially leverage loops that amplified risk. Pushing back on that, Haseeb has rejected the thesis, arguing the timeline does not fit. You also saw a guy from Athena arguing the same, that liquidations were already underway and USDE's stress followed the liquidations, and that the divergence was venue specific to Binance. Evgeny from Wintermute is saying 1010 was a flash crash, very macro driven in an extremely leveraged market. I'm going to take a slightly different point here to who specifically is at fault, and instead ask the question this way, which is, Chris, Cosmo, if we're in a market where people can still be arguing about this sort of thing at this point without any clear, even causal mechanism for what happened, is the problem with getting people back itself the opacity of that market? Like, if you're a retail trader, how do you look at this and say, I should get back in that pool?
Cosmo,
yeah, for sure. Yeah, I mean that's it's absolutely a problem. There's a lot of navel gazing right now going on in the industry, as there should be. There are plenty of players who have treated retail like extraction opportunities, as opposed to a an opportunity to create value together. And so, the industry has to get together. It's not just any one party. It's not just any one segment. Like, really, the industry has to get together, fix it, because that is the structural problem, the lack of trust in the market. It turns out trustlessness isn't necessarily a good thing.
I think the first thing it tells us is the magnitude of 1010. Why the hell are we talking about this in 26? Because it gutted a lot of retail. It gutted the market makers. It had a material impact on liquidity for months, and it explains a lot of the price action that we've seen. And so, that's the first thing, is this is big. We had more sizable liquidations than FTX. So, monster impact on our industry. Unforgivable, I would add, because there were plenty of ways to avoid it. Now, in the discussion between Star and Binance, he focused on one thing, and that's collateral, as one of the items. Is collateral important when you're running a clearinghouse? And like I was literally locked in a room with the Fed to help design clearinghouses after the global financial crisis, after I left Lehman. So let's just go through it a little bit. Yes, collateral is very important. You look at all different things when it comes to collateral. You look at, it can't be too volatile. You certainly don't want to get it bank. You don't want it to go bankrupt. And so that's one element, but it's not every element. Let's talk about Athena specifically, Austin. We've had this conversation. When Athena was first pitched to me, I passed on it. And I passed on it because they said, this is a stable coin. And I said, it's not a stable coin. It's a hedge fund. It's a really good hedge fund strategy. And like, I just couldn't get past my own self. And like in some places in crypto, you kind of, your past kind of shades your view. And the fact of the matter was, Guy is great. It's an incredible project. It makes a ton of sense. It's democratizing access to a hedge fund strategy, I think, for many, many people. So that's great. It's not a stable coin though. Like stable coins in my mind are now it's certainly not Genius compliant. So like, do you want the most pristine collateral when you're using it it's to support derivatives? I think you want it as pristine as possible. There are well-known risks with Athena that people should know about. But was Athena the problem here? I don't think so. I think the problem was that the clearinghouses, I shouldn't say clearinghouses. I should say exchange, because there aren't clearinghouses in crypto. Certain regulators forced all the derivatives offshore because they said everything was a security. And offshore, we didn't have the guardrails that have been adopted, by a lot of people to make sure that this ADL doesn't happen. We talked about it, over and over again. ADL is a failure. What happened on 1010 was a failure because two things happened. Confidence was lost because people who were hedging got liquidated, even though they were in the money and they were right. And when you lose confidence, you lose everything. It left a lot of holes in a lot of balance sheets. I've talked to a lot of these counterparties. They're still getting topped up. I think we're near the end. And I think those balance sheets are getting repaired. So a lot of people raising capital after that. And hopefully that's sorted. But it's a lot bigger than collateral types. It's the fact that you don't have any risk management. And I would be thrilled to partner with anyone who'd like, on some of the lessons that we learned after the global financial crisis.
So I'll close that out by coming all the way back around to where we had started, which is, here's where having a proper understanding of the mechanics really matters, and the regulators doing their jobs really matters. Is you want frameworks to create rules for these things. A lot of these are solved problems. By the way, here's an area where you definitely want yield on stable coins. If you're a bank and you brick yield on stable coins, now you don't have yielding collateral for derivatives in the crypto space that is pristine in the way that Chris was just talking about. And I think ironically, you're just going to make things worse off. And hilariously, Chris, to your point, push it all offshore, because the choice is not yielding stable coins, yes or no. It's yielding stable coins in the US or yielding stable coins in other jurisdictions, right? Because the interest exists whether we let people pay it or not here. Mm-hmm. And so if people hear nothing else from what Chris just said, understand there are system designs that actually handle these concerns without going all the way to the bottom of the stack and just wiping out the people using the system, because then it's hard to come back from that one.
But it costs them money, right? You have to put your own money at risk. And for the exchanges that are making an insane amount of money on perps, like very, very lucrative, they make money every time there's a liquidation. Some of that should go in to guarantee the system. I'll tell you something else. In trad markets, we have these things called insurance funds or guarantee funds where the members contribute to a pool. And the fact of the matter is like, they're like, we can't do it because we don't have members, so we don't have the pool. Yes, you can have the pool. Very, very easy to engineer an LP, like a liquidity provider tranche, where people can post money into a guarantee fund. That money is at risk. There's amazing disclaimers. They benefit through the protocol's revenue or the exchange's revenue for putting that capital up. There are a million ways to design it, and it has to get fixed. Now's the time.
All right. So before we close out here, Cosmo, have we missed anything in this discussion about 1010? And do you have anything you want to close with as somebody who is yourself an investor in this space?
Look, I always like to end with a note of optimism. The reality is the more that we break open these wounds, the more that it becomes clear, like the more that people realize things need to change. And frankly, I mean, the lower prices go, the better the risk reward looks. So all these things, now it's much easier to say now than it was pre-1010, and hopefully we said that pre-1010. But look, prices are a lot lower. I think generally fundamentals are a lot better and trending in the right direction. And so we just need to dissolve some of that indigestion, and then we can keep going again.
All right. So there you go. The positive outlook of just keep digesting your food. But no, joking aside, I'm actually very optimistic on the technology itself and the forward path for the industry here. Individual tokens, your mileage may vary, but I don't think there's actually been a better time for the industry and the forward path of adoption. So, all right. On that note, thank you for joining us for this episode of Bits and Bips. We'll be back in 1 week to discuss more about how the worlds of crypto and macro are colliding. Until then, thank you, everybody. Cosmo, thank you for fighting through the audio and video difficulties to join us.
Chatting,
We appreciate
gentlemen.
it.
Thanks, buddy.
Yeah.
All right. Take care, sir.
Cheers, guys.
If you're looking for help with crypto taxes, Crypto Tax Girl is offering $100 off for Unchained listeners. They provide personalized crypto tax reports and returns, and spots before April 15th are limited. Go to cryptotaxgirl.com/unchained to save $100. Once again, the link is cryptotaxgirl.com/unchained.